welcome back. You're watching The Money Show with me, Kavita Thapliyal, and today let's focus on stocks and having an exit strategy in your stocks or your stocks portfolio. What sectors should you be getting out of? Let's focus on this discussion today. I have with me Aditya Agarwala, Head of Research and Investment Invest for Edu. Aditya, hi, good evening and welcome to the show. So very often you're on the shows where you recommend stocks, but today let's talk about exiting a stock. Okay, so it's very important first of all for you to know the reason why you have bought a particular stock, for what time horizon, if at all you have a purpose or a goal aligned to it. Okay, but then there has to be a time when you have to take that call to come out of that particular investment. Okay, so what should be those criterias or parameters?
Good evening, Kavita, and thanks for having the show. Yes, I do recommend stocks most often, and while I recommend stocks, it is very important, as you mentioned, to know when to exit the stock, and it's important to exit the stock. Unless you exit the stock, you're not actually making money. So, best time to create riches is only when you sell your shares, and money is only made when it's actually sold and it's transferred into your bank account. Notional gains are only good to look at, but unless and until you book profits, they are not your actual returns that you're making. So there are two methods, Kavita, which can be used to sell your stocks. One is a fundamental parameter, and next is a technical parameter. Fundamental parameters can be very basic, like the company's future growth, if that is stagnating, and there is no promising future developments that you see in the company, and the reasons for which you bought the company is unfortunately not performing the way you were looking at. And then there are opportunities in other pockets. There are green shoots seen in other sectors and stocks. So that is one criteria to look at to exit your stock. The stock can be in profits, the stock can be at loss. But yes, it is important to stick to the thesis which you had picked while picking the stock. And if that thesis is not standing true after a few quarters, it's important to relook at the stock. And if it's not standing true to itself, then it makes sense to exit. So that is the fundamental parameter that one should look at while exiting the stock. The second is a technical parameter as well. Now, often there is a argument and a debate that one should look at technicals, one should look at fundamentals. I believe one should look at both because both go hand in hand. And there are times when fundamental indicators are ahead, and there are times when technical indicators are ahead. So it's also important to look at the chart setup of the stock that you have bought. Many a time what happens is we end up buying the stock at a peak only to find out that the stock is correcting from that point of time. It is just that the company is good, just that your entry point was wrong. So whenever you are sitting on decent gains, the stock prices have shot up significantly, and they have reached extreme overbought levels. They look stretched. It's time to look at selling, or at least booking some partial profits in that stock. And how do you understand that the prices have reached extreme stretched levels? There are several indicators which will tell you that the stock has reached extreme overbought levels. Look at the historical setup of those indicators. If the current setup is somewhere close to that, then it shows that it is sitting at extreme overbought levels. Then there will be a price correction which will follow that, and then the supports will break. Stocks will start to form lower highs, lower lows. A classic example, if I give you, was the recent case of Adani Ports. The stock gave phenomenal returns to its investors. But now, if you just believed in fundamentals, and if you did not look at the technical setup of the stock, you would have not exited the stock at a very good price. You would have exited much lower. So both one should look at, and the technical parameters and the fundamental parameters. And when both are in conjunction and both go hand in hand, that is the time you stay invested. When any of the parameters suggest the reversal, you should actually look at exiting the stock, or at least booking some partial profits, and then revisit your thesis, and then do a reanalysis of your portfolio and stocks that you have.
Right. Right. So, Aditya, let's focus on specific sectors, and I will also come down to specific stocks, but then this question is specifically about sectors which are not red hot for you and have already had their own run up, their time is gone, and you should be just exiting these sectors. And why?
I believe, Kavita, there are a whole host of sectors which have shot up too soon, and a whole host of stocks which have shot up too soon, just on the basis of few developments. Maybe those developments have not materialized on the ground yet, but the price action has been swift and very sharp. You should be a little cautious there and look to exit stocks there. And to start with, one sector that I have identified for our viewers today is the Nifty PSE index. Look at the way that the index has moved in last 3 years. Just this year, Kavita, the index is up 40% year to date from Jan till now, while most of your broader markets have not given any significant returns, be it the Nifty or the Bank Nifty. So this is one index which has outperformed big time. They look little stretched. RSI is sitting at above 80 levels, and this is on the high time frame charts, Kavita, that I'm talking about. This is not even daily or intraday charts. This is a week, monthly development that I'm talking about. So these prices have sustained for a good 1 year, and last 3 years it has given phenomenal returns. So at current levels, RSI is indicating that the prices look little stretched. RSI sitting above 80 is not very normal for the index. It has done very few times in the past. And whenever it has done so, the minimum correction that is followed in the index is 15%, Kavita, and the maximum correction that is seen was somewhere around 55%. I'm not saying that the index will correct 50% or it will correct 15%, but the historical data suggests that whenever RSI reached above 80 levels, it's time to look at booking profits. There's no harm if you're sitting on good profits to at least book out profits. And markets have turned volatile. We know that as well. So it's good time to look at booking some profits in the Nifty PSE index. The next two indices are not actually sectoral indices, but they're broader markets. I believe Ekta broader markets are also too heated up at current levels, and one should look at booking some profits in the broader markets. And when I talk about broader markets, I'm talking about the mid cap and the small cap indices. Again, these indices have given phenomenal returns year to date and in the past year as well. And again, the technical setup do suggest that they are too stretched. RSI is again sitting at 85 levels on high time frame charts. These are not normal levels on a high time frame charts. These usually develop after years of or months of outperformance. Again, the correction can be swift, and before you know that the stocks have started correcting, you exit the stocks, you will witness a 15-20% easy correction on your stocks. So I'm not saying that exit completely. At least pay heed to the fact that correction is around the corner. Book out profits where you're sitting on decent gains in the mid cap and the small cap spaces. Trim your portfolio, sit on cash. There's no harm on sitting on cash. It's very important to know when not to put money rather than knowing when to put money. Because if you put money at the wrong point of time, the chances of you getting stuck at a higher level are very high. So this is a time when we are strongly recommending, at least in the broader market space, sit on cash, book profits, at least some 50-60% of your portfolio where sitting on decent gains, sit on cash. There's no harm, Kavita. So these are the three indices predominantly where I see some kind of I wouldn't call it a bubble, but yeah, a froth kind of a building up, and it's not a bad time to book profits in PSE index, the mid cap and the small cap end of the market.
All right. So, so keeping the same analysis, what kind of stocks do you think people should come out of? Because based on their fundamental reasons of investment, or maybe they have adopted a technical technique to it. But specific stocks, if you have on your radar, where an investor can make an exit strategy, or maybe start thinking of one, what would that be?
So, Kavita, there are a whole host of stocks which have multifold in last few months or maybe few quarters. To begin with, they are the railway stocks top of the list. I understand that there are a lot of development happening in the railway space, and just ahead of the elections, there are a lot of projects which get assigned, and a lot of tenders will be floated. But again, look at the way all these railway stocks have shot up. You name it, RBNL, Aircon, Railtel. Barring IRCTC, I believe the whole host of railway stocks have shot up. And at current levels, if you are looking to enter, I would strongly caution you not to enter. If you're sitting on good gains, which could be easily in the range of 50-60%, it's not a bad time to trim down your exposure in railway stocks. I'm not saying that these stocks won't perform in the long run, but there's no harm in booking profits at current levels and looking to re-enter when the stocks have corrected, because the way these stocks go up, they correct also sharp, and you don't get a chance to exit in these stocks. So railway stocks are the first of the lot which I'm recommending strongly to book for partial profits, or at least if you're looking to exit, you can look to exit there and look at re-entrance at lower levels. Second is your some of the PSE lots, names like REC, PFC. Look at the kind of moves that they have shown on the monthly setup. RSI is sitting at 85 odd levels, which the stocks have never seen in the past. And from these levels, it makes sense to book some profits. You can add a Coal India to it as well. Too sharp move. We have not seen this kind of an up move in Coal India for years. So now it's looking little stretched as well. So PFC, REC, names like Coal India, it's not a bad time to look at booking some profits there. Then comes your defense and your shipyard stocks. Look at the way the names like HAL has shot up. And looks like there are multiple negative divergences building up, Kavita. Though the defense sector is hot right now, and stocks can perform there in the long run. But again, you'll have to relook and rebalance your portfolio is what I would put it as. If your exposure is too high in these stocks, I would suggest trim down your exposure in these stocks, be a Musgao Dock or a Cochin Shipyard or a HAL. It's no harm in trimming down exposure in these stocks. They look a little stretched, and a correction is around the corner in these stocks. And then few PSU banks as well, which have recently outperformed. Could be a Bank of Baroda or a Union Bank or an Indian bank for that matter. All these smaller PSU lots, they have shot up in a short span of time, too much for them to sustain at these levels for the long run. So I believe these are some of the stocks, especially your railway stocks, PSU banks, PSE stocks, and some of the defense stocks. I believe it's prudent to book profits ahead of any correction kicking in on any of these names.
All right, great analysis. Thank you so much, Aditya, with that for being on the show and helping our viewers in forming an exit strategy in a stock. Thank you.
Thank you so much.
All right, time for a quick break, but then post that, let's get your mutual fund portfolio queries answered by Shweta Rajani.